So the second objective, we explain why companies use performance evaluation systems. And let's start with the performance measure. You mean by... Alright, so I'll give you an example. So let's, and I think that example was in your book. So let's say we have a set of hotels, alright? Let's look at the, for example, DoubleTree Hotel. So what they do, in fact, they segment their business by property. And each property is going to share one centralized reservation office, alright? And one centralized website. At the same time, because it's decentralized, we said by what? By property, right? If we have this centralized, it means there is no duplication of costs, right? So when our person is calling in, trying to, let's say, make a reservation or something, right? They're going through one system, right? That's your avoiding duplication of costs, right? Whether if you have it decentralized by location and you have a person sitting and doing it at each location, that's increased cost, right? So let's say I have one person sitting, I don't know, in Seattle and doing all of the reservations for US versus if I'm calling to that particular location and reserving right there. Do you see how many people I might be hiring and how my cost might be going so much higher, right? Does it make sense? All right. So right now it's a second nature to you, right? But it's a second nature that the business is going to try to avoid duplication of costs, right? But this is just for you to, I know it's probably you're thinking, okay, well, it doesn't make sense. How do they duplicate the cost? It's just that could have been a disadvantage if they were to do that, all right? All right, going forward. So we're trying to explain why our companies are using performance evaluation systems. All right, so we have different performance measurements that we've talked about. Now let's just overall go through the performance measurement that serves our managers a purpose. So what is it? We provide our top management with a framework for maintaining control, right? So once our company decentralized, right, we've learned all these tools, but now we're applying a new concept of decentralized company. So once the company decided to decentralize, our top manager is no longer going to be involved in every single decision-making process, right? But at the same time, top management needs to know if those decisions at the decentralized, at that subunit level, are effectively meeting company goals, right?
Can you give an example of a company that would be very centralized versus a company that would be more decentralized?
Well, like we said, decentralized is going to be a bigger company, right? So a centralized company, Someone gave an example? Yes, I'm just, I don't know, local bookstore, right? Versus Barnes and Noble. It's hard to name it because it's usually a smaller company, right?
It's not like either or. It's kind of like either more or less.
It might be highly specialized local
okay.
store, maybe just a general local store, but it's usually a smaller business is what it is.
Is more centralized.
Okay. Mm-hmm. Right? Okay. Right. All right. So let's talk a little bit more about the performance measurement. So go back to it. Okay, so our decentralized organization, they need such a system that would communicate not only different goals, but also some ways of evaluating achievement of those goals, okay, to our subunit managers and firm. So what is the primary goals? We have a number of them: promoting goal congruence and coordination, communicating expectations, motivating unit managers, providing feedback and benchmarking. All right, so hold on. I want to talk to you about something else here. So obviously there are also going to be some limitations of our financial performance measures. So what are those? I'm just going to talk briefly about it. I don't want you to have a slide on it. All right, it's just for you to have in mind. So obviously we're going to have some systems that are outdated, and they might not be entirely accounting for all of the financial performance of the company. Some also managers are going to have, the problem is probably going to be also with our managers leading or insisting on certain goals that might not be a part of the business. Okay, that's also some of the drawback and limitation. And also, not always our managers are going to be able to signal back, predict performance over the longer period of that decentralized location. So let's look our performance reviews to evaluate cost, revenue, and profit center. So here we're going to spend quite some time. All right. So what do we do with our performance report? What is it for? The performance report is so that we can capture the financial performance of cost, revenue, and profit centers, right? So we've talked about those centers a little bit. Now, our cost center is going to include all the information where the actual costs are compared with budgeted. Our revenue center is our actual revenue with budgeted, all right? And the profit center, where your actual and budgeted information on both revenues and costs is included. So that's the performance report, 3 parts of it, right? Also, I wanted to note that the profit centers, while they are responsible for both, while the cost and the revenue just have the actual comparison to the budgeted of the cost or either revenue, the profit is going to combine all of it. Okay, so it's going to have both parts. So pay attention that that's the difference between them. Now let's look at each one and see how they look, what are they composed of, and how we calculate them. All right, so cost center performance report. Let's look at the control costs. So usually is a good indicator is our flexible budget variance. What is a flexible budget variance? It's the difference between actual and the flexible results of let's look at the payroll, for example. So we have our flexible budget variance. It's a payroll processing department performance where we have salary and wages, payroll benefits, equipment depreciation, supplies, and other expenses, and we calculate our total expenses. Now see this, we have our flexible budget variance calculated, and it's either favorable and unfavorable. And we also calculate the percent of variance, all right? So that indicates to us a level of the performance of a level of the performance for that particular unit. All right. So also, sometimes you're going to see that the payroll processing department only is going to incur expenses and not quite generate any revenues. So you will see salary, wages, payroll, benefits, and such, calculating just our total expenses, right? So that's why we're going to consider it as a cost center, right? Our expenses is our costs. Okay, the next one, revenue center performance report. So how is this going to look? We'll be generating our sales revenue, and we'll look at the specialty DVD department performance report. Again, the same smart touch. Okay, so what did we say? We said that our revenue center reports are going to look at flexible budget and the by comparing actual sales and the static master budget, right? Okay, so we're looking at flexible budget variance and the sales volume variance. We have number of specialty DVT and the special DVT. We're calculating our sales revenue. For the actual sales, we have flexible budget and the static budget, and we're comparing the three, sorry. Okay. Do you have another? No. All right. So let's go to the next one. So we have profit center performance report here. In profit centers, as you remember, our managers, they were responsible for generating revenue and controlling costs, right? So we're going to be combining the two right now. So we're producing profit through generating sales and controlling costs. So let's look at the DVD performance report, just one line of product. So what do we have? We have sales revenue, variable expenses, contribution margin, traceable fixed expenses, and then divisional segment margin. We also calculate our flexible budget variance and the percent of variance, right? Okay. We also remember that one of the drawbacks of the decentralization is that sometimes our units are going to be duplicating costs, right? As well as assets. Yeah. Okay, so how can we see it here? Where our costs and assets might be duplicated? What do you think?
If you're buying something in bulk, you get a reduced price the bigger quantity you buy. So if a bunch of different companies are buying it, then you get the less benefit from the bulk. So that'd be a variable expense.
All right, that's a good example. So let's look at the performance, some other. Before we do the exercise, hold on a second. We'll do that in a second. So just in general, let me just reiterate what our performance reports are for. We use management by exception to determine which variances are worth investigating. So we'll look at the three reports and we'll see which one is probably the outstanding one as for costs, right? And we'll investigate why. We'll also look at the variances only, all right? So you're not going to look at all the numbers. More likely you'll go just through your variances to see which one is really standing out for you, all right? Usually it's done by the software, and then, you know, the red flag is going to pop up in some numbers. Then your smaller variances are not going to require any attention, right? So only the ones that are of a larger number of the ones that requires most of the attention. It also allows managers, because it's, you know, quite removed when the company is decentralized for the manager. It doesn't truly pose a lot of blame on the extending manager, right? But rather makes you to investigate what's actually happening. So this allows you to focus on information itself rather than a person. And also you are focusing on underlying reasons for performance, and you are able to take corrective measures, actions. Some variants are going to be uncontrollable, so those are also your lowest priority, right, if any. Alright, so let's look at this little example. So what we're trying to do is to say which center is described here. So just to remind you, it's a profit, revenue, investment, costs, right? Alright. So each of the following managers has been given certain decision-making authority. Manager of Holiday Inn's Central Reservation Office. So what are they doing in reservation office?
Centralized?
They're creating a revenue.
No.
Alright? So that's where you should be coming from. So that would be your revenue center. Managers of various corporate-owned Holiday Inn locations.
No revenue.
Huh?
No revenue. They don't create the revenue.
Who?
The managers. Just manage.
Huh? Huh?
What are our options?
You have revenue, profit, investment, and cost.
Costs.
Investment.
Revenue, investment, profit, and cost. Is it revenue
How can you
or is it profit?
how can you determine if
You're
it's
trying
based
to
on-
identify what is a certain decision-making authority that they're given, likely. Why that decentralization took place,
So it's decent.
right? How companies decentralize. So the reservation office is by revenue centers. The managers of various corporate-owned Holiday Inn's locations.
How would you know that? Like how do you connect?
You're
like-
trying to understand it, right? You're trying to deduce that information from what's given to you. It's a guess, right? Educated guess.
Yeah, but you can guess it wrong.
That's right. So you will try to understand why is it wrong, right?
So going back up to letter A,
Mhm.
why is a revenue center?
So we're trying to see what type of responsibility that that manager has at that center.
Okay. So
Right.
how is revenue
So
center?
manager of Holiday Inn's Central Reservation Office. If it's a central reservation office, that manager is likely to have what responsibility,
Building revenue.
right?
Reservations.
We've talked about the revenue, right? Managers of various corporate-owned Holiday Inn locations. Managers of various corporate-owned Holiday Inn locations.
Investment.
What are they working on? You have investment, profit, revenue, and cost.
Profit.
Alright. Manager of the Holiday Inn corporate division. If it's a corporate division,
Also profit.
why are they investment? It's a higher level, right? So we have a manager on the level of a corporate division. He is unlikely to work with, to be responsible for creation of the profit, right? Maybe managing the investment, yeah? Okay. Manager of the housekeeping department at the Holiday Inn.
Costs.
Why is it a cost?
They're not to manage over an expense.
It's not
Alright.
generating.
So do you start to understanding it better? Alright. Manager of the Holiday Inn Express corporate division.
Investment.
So we have again this corporate division, right? that's overlooking the investment strategies. Manager of the complimentary breakfast buffet at the Holiday Inn Express.
Cost.
Why is this cost?
It's not generating income.
Alright. Is it better?
So what's the difference between revenue and profit?
Well, your revenue manager was doing here what? He was responsible for central reservation office,
So is that more of an account?
right? And then profit, various corporate owned Holiday Inn locations. It's a level of decentralization more than anything, right? Right?
What I'm saying is, this is very like. I don't know.
That's for you to try to understand the concept.
Because like I'm like reading the homework right now for like a question like this. It says the full-time baker who will manage production and product costs and a web designer, sales manager who will focus on increasing sales. So when it's given like a description like that, like the web designer will focus on increasing sales.
Try
So
to understand the concept rather than learning by heart, okay? It's just for you, before we go into all of the investment center definitions and evaluations, this is just for you to get a feel of it, okay? So
No, I understand
different decentralization is going to lead to different level of responsibility of a manager, and that's how you will try to understand what center that manager at what center this manager would have the responsibilities as following. All right. So take your best guess. Try to play with this and say, could that be true or could that be true? All right.
Like on a test, it would be like a guess. Like, you know,
Well,
like,
that's
it'd be more like.
okay. That's not. All right. Use ROI, and EVA to evaluate investment centers. So here I want you to pay more attention because it's a lot of calculations and who knows, right? All right. So we have our investment centers, and that's all we're going to be talking for the rest of the class today. So as we said, in our investment centers, our managers are responsible for the following. First, we're going to be maximizing the income, right? And that's going to be based on that investment that investment capital that the company made. And we'll also use the company assets efficiently so that the best is taken out of that investment center's asset. So how would we do that? How would we as unit managers do that? First, our manager is going to take decision-making responsibility over all of the assets of that unit, of that division. It's not going to be evaluated can't agree with this all the way, but okay, cannot evaluate investment centers in the same manner as profit centers. True. We'll look at this. Let's just concentrate on performance measurements right now. So our performance measurements are going to serve a couple purposes. First, we're going to try to determine how much of that operating income our division is generating, that decentralized unit, and how efficiently the division is using the assets the company invested in. All right.
Can you tell us what RI and EVA are?
Yes, we'll go over this in a second. Okay, so our managers have the decision-making responsibility over all of the assets, and let's see how those performance measurements are discussed further. So what is an ROI, RI, and EVA? Anyone knows? Uh-huh. That's EVA, economic value added. Huh?
Economy value added.
Alright. What's the KPI?
Key performance.
Huh?
Key performance indicators.
Index. Alright.
Indicators.
Yeah, I've heard that too before.
It's not index, it's indicators.
Indicators or index, it's the same. Okay, so KPIs for investment centers. This is a good illustration of how and what they're determining. Alright, so we have our 3 KPIs. So division's operating income and the division's average total assets is what we're going to be working with. So we have our return on investment, ROI, economic value added, EVA, and the residual income, right, or RI. So all of these 3 incorporate our division assets and the operating income. And we're going to be using just the data for the division that we're evaluating, right? Not for the whole company. We're trying to evaluate just the center here, okay? So never use the whole company's numbers to evaluate the center. Just a warning, you know. I'd love to see it somewhere. All right, so let's look at the first one, and that's return on investment, or ROI. So what is it? It's an amount of income an investment center earns relative to the amount of its assets, right? So it's our operating income divided by average total assets. Okay, so what are we measuring with this? We're measuring the amount of operating income an investment center earns, right, relative to the amount of average total asset. So the ROI, a division with a higher ROI, therefore, is going to be more likely to receive extra funds, right? Because it's providing a higher return, right? The higher ROI, the better, the higher amount of funds it's likely to get. Now, luck and not so much is that we're comparing across all divisions and all time, okay? Some are going to be performing better, some are not, depending on the timing as well. And it can be also be used as a benchmark to compare against the industry competitors or itself, right? So let's expand the definition of ROI and see what our managers, how our managers are working with ROI. So management often restates the ROI equation as following. What are they doing it for? They're determining what drives division's ROI with this formula. So they take operating income, they divide it by sales, and then they multiply it by sales over average total assets. Now it's the same thing, right? It's still operating income divided by average total asset, but what is it giving to us? The expanded version is going to show us first as a profit margin, right? Operating income divided by sales. So what it tells you is how much operating income that division earns for each dollar of sales. And then the second is the asset turnover. And asset turnover is how efficiently a division uses its average total asset to the generated sales. So asset turnover is the sales divided by average total assets. So you can say that the ROI is your profit margin multiplied by the asset turnover, right? All right. So expanded version of ROI gives a little bit more insight into what exactly is happening with that unit. So let me go over the example really quick. So what we have here is our extreme sports company. They make snowboards, downhill skis, and such. The company found it beneficial to split operations into two divisions based on the climate required for sports. Snow sport and non-snow sports. The following division information is available. So we have our two divisions: sales, operating income, average total assets, current liability, and calculated ROI. So they specified that they want a 16% target rate of return. And the company weighted average cost of capital is 10%. Its effective tax rate is 38%. So let me explain to you how we, actually maybe even two, I'll see how much I want to explain. Calculate each division profit margin, asset turnover, and ROI. Alright, so how do we calculate it? First, let's remember our profit margin is operating income and sales. Right? That's one of the components we said, correct? So we said that profit margin is operating income divided by sales is one part of the equation. And so we can calculate our profit margin. We have all the information given from snow sports and non-snow sports. So we plug it into the formula and get the profit margin. So what do we see here? We see that profit margin is 17%, right? The same for snow sports and non-snow sports. What would it mean?
It's high.
That simply means that we're able to earn 17 cents of income on each dollar, right, of the sales. Okay, so this is your interpretation. So what does it mean that they have the same profit margin?
They're earning the same company, the same, they're equal.
They're equally profitable, right, on sales. All right. So let's compute our asset turnover. That's again the second component, right? We've done the first, now let's work with the second. It's your sales divided by total assets. Now I'll put together again a table where I just plug in the numbers and find the asset turnover. So what is it saying to me? That my snow sport is 1.22, right? And the non-snow sport is 1.25. Those numbers are obviously rounded. So what is it telling me? It's telling me that the non-snow sport division is able to generate $1.25 of sales, right? For every dollar of assets that the company invested in, all right? So what is it telling us also? It means that the snow sports, or maybe non-snow sport, tell me that. Which one is more efficient? That's good. All right,
I
so
would think that snow sports would be more efficient because they have more excess income to be able to use however they want.
and you're saying it. What did you say just a second? Did you say non-snow sport is more efficient?
It's more efficient. It's 1.25. I mean, if I'm investing in buying assets, I can buy more assets in here. I will generate
So
more
the
money.
snow sport division is generating $1.20, 22 cents for every dollar of asset invested. Right?
This one generate 1.25.
All right. So now we need to calculate our return on investment. We just calculated the asset turnover and we calculated the profit margin. So let's look. Right? We're just multiplying the two. And what do we get? 20.7 and 21.3 where there's no sports and no sports, right? You're just plugging in the numbers that you just calculated into the formula, profit margin, the asset turnover. So what does it mean? What does it mean that the ROI of snow sports is 20.7 and non-snow sports is 21.3?
Oh, got 21.3 cents on every dollar that sells in terms of volume.
Okay. In other words, anyone else?
As income.
Return on investment, right?
Non-snow is quicker.
Non-snow sports gives you return more of your investment in snow sports.
All right.
Wrong business.
Huh?
So they're in the wrong business.
All right. Interesting. Okay. So let's look at the where do we use this return on investment? Before we go. We usually, before we go here, just give me a second. So we usually going to use our return on investment when the manager is probably willing to investigate either profit margin or asset turnover, right? So let's look at the second one, residual income. Right? So if a question is asking you, what is the return on investment for? You remember the formula, right? It's so that the managers can investigate the profit margin and asset turnover and pinpoint where is the broken link, right? Where is the weak spot of the business operation. Alright, so residual income is the second one. We have another commonly used KPI here. So let's evaluate the investment center with residual income. What does it do? It measures the division's profitability and the efficiency with which the division is using the average total assets. So by which means are we going to do that? First, we'll compare the division's operating income and the minimum operating income expected given the size of the division or unit assets. Alright? So if that comparison shows us that the relationship is positive, then our income exceeds targeted rate of return. And if it's negative, then we are not meeting the target of the rate of return. Okay, that's great, but let's look at the ROI equation. So what is it saying to us? So the ROI is operating income less minimum acceptable operating income. So just to understand what is this minimum acceptable operating income, we write out the residual income formula. And it's operating income minus targeted rate of return multiplied by the average total asset. Right? So that's what our top managers are going to expect to for this division to earn, right? To earn as with the average total assets given these second part, right? The average total assets. So this is your minimum acceptable operating income. All you're doing is just writing it out. So what is this target rate of return? Do you understand what is the average total assets? Targeted rate of return is your minimum acceptable rate of return. Management is expecting a division to earn, right? So when we are when the relationship is positive, we're exceeding an expectation. When it's negative, we're not as effective. So why would we use this residual income? Again, just understanding from the definition of the residual income. First, it's better than ROI in terms of goal congruence, right? We're working with the target rate of return and the average total asset here. and we're comparing it to the operating income. Alright. One of the big advantages is that the ROI numbers are usually better at motivating than ROI, our division management. Alright, so let's look at the economic value added, EVA. That's your special type of ROI calculations, okay? So we're still talking about the ROI really. Alright, so look at the, we're looking at the division's residual income, and we're trying to understand what is its value to the company's primary stakeholders. So we have two players, investors and creditors. Investors are our owners, the creditors are the bondholders, and we have them evaluating stakeholders willing to evaluate how efficiently that division is using its assets. So what are we going to consider here? Our after-tax income, assets used to generate after-tax operating income for stakeholders, and then minimum rate of return that's required by stakeholders. Okay, so economic value added has two players, investors and the creditors, right? All right. So let's compare the EVA with the ROI to make it clear what's the difference. So look at this. Our ROI is only operating income, and EVA is after-tax operating income, right? And then the second part we said for ROI is average total assets multiplied by the target rate of return. Now what we're going to do for the EVA, we'll subtract from the average total assets the current liabilities first, right? And then multiply it by weighted average cost of capital. Okay, so it's augmented, right? EVA is similar to ROI, but it's subtracting everything that needs to be accounted to help stakeholders to make a decision. All right, so what are the differences? Again, EVA is going to use our after-tax operating income, reduces average total assets by current liabilities, and we replace management target rate of return. All right. Let me see if there's you're lucky today, you're not gonna have a quiz, but I want to finish this. Yeah, it's the last day, so I decided not to. But who knows, maybe something on Wednesday coming up. All right, so let's look at 24/7, and let me go over this just to help you to settle this RI down. So Extreme Sports Company, again, we're making snowboards, same story, right? Now, what? We have the same information given to us, right? Sales, operating income, average total assets, current liabilities, and ROI is given to us. We have the same, the rest given. Now what we need to do is instead of ROI, we'll try to compute RI, and then compare it to the previous results that we got. All right. So we're going to start with what? With the formula. So our RI is operating income less the minimum acceptable income, and we said that it's target rate of return multiplied by total assets, right? So once we calculate these numbers for snow sports and non-snow sports, we see that the snow sports RI, I'm just plugging numbers in off the table, right? I think you're going to have an exercise on this. You plug the numbers in, you find your snow sports RI. Now pay attention, it's in dollars, right? Although it's we're looking for the rates. Okay, so now non-snow sports, again, we found that is 356,000 versus 215. So what is this income telling us, right? Residual income. What is this indicator showing us? both values are positive, right? The residual income is positive for both non-sport and the sport. So we're earning some income. Looks like the results are consistent, right, with our previous ROI. All right. So let's look at the second part, where we're going to be calculating the EVA. The same information, we're going to be comparing later EVA with the RI, right? Because we said that EVA is an extended version of RI for our stakeholders. Okay, so how do we do this? Again, we put the formula together for the EVA. It's our after-tax operating income, right? Minus total assets, current liabilities, and WACC. So how do we plug in numbers in? Okay, they're all given to you and they will be given to you. So this is an example of just knowing the formula, plugging in the numbers, done. Okay. So we calculated that the snow EVA is 171 and the non-snow is 284,860. So what is it telling us? They both have the positive economic value indicators, right? So both are generating income. It's probably also telling us, and tell me how you can see that. It's probably also telling us is that our long-term creditors are our long-term credit exceeds the expectations. Okay. The expectations of our long-term creditors is exceeding the numbers that we're getting, all right, for both the stockholders. So let me see, right, we have the positive economic value added, and so the divisions are generating enough income for the investors to have a positive outlook for our creditors and the stakeholders, right? All right. Hold on. All right. So also, just for you to see this, so these are all the different indexes that we've gone through. There is a table in your book. I didn't write down what it was exactly. It's the 3 investment centers for KPIs, and it summarizes the equations. So make sure you look at it. All right. It's a good summary of all of the formulas. It's really easy to work with this. But we're not having the quiz, right? But it's still 10 minutes, so let's go over through exercises. So the Quaker Foods division of PepsiCo is most likely treated as revenue center, cost, investment, or profit. Any idea? It's your Quaker Foods of PepsiCo. Okay, I hear a revenue, I hear investment, I hear profit. Which one is that and why? It's a profit. We have Quaker Foods, right? It belongs to PepsiCo. It's an investment, that's right, Ben. It's an investment center. Alright? The performance, I have some selected, so I wanted to go. You're going to have more. By the way, the slides are already available, I believe. The performance evaluation of a cost center is typically based on its sales volume variance, ROI, static budget variance, flexible budget variance. For the cost center, what is it? Why is it a flexible budget? performance evaluation of a cost center. Why is it a flexible budget? Yeah? Okay, that's good. You're comparing the actual to the budgeted, right? Or not? Yeah? Okay. I think. So that would be a multiple choice question. Okay, if you were to calculate the following data applies to question, assume, so you have some data for residential division of Keeper faucets. You have sales, operating income, such and such. You need to calculate your profit margin. So here's what I'm expecting you to have is an understanding that the profit margin is operating income over sales, calculate it, and get the percentage. That's as far as